Footprint charts helped me reinvent myself as a day trader after I had already been professionally trading for close to a decade. Today, we're going to look at the critical edge footprint charts can provide to help you build context around your trades, validate setups, and better time your entries and exits. In 2008, I was 5 years into my career trading for Great Point Capital in Chicago. The majority of us at the firm back then were pure level 2 traders. Other than a level 2, all I had was a basic candlestick chart with volume. That's it. I would use a level 2 in order to determine when large buyers or sellers were entering the market, creating imbalances, as well as to identify critical support and resistance levels. I profited by following the moves of other time frame participants as they entered the market, or by taking out support and resistance levels that I knew a lot of local traders were leaning on as they're out, and I would cover into their panic. 2008 was an important year, as it marked the first time in history that algorithms accounted for more than 50% of the average daily trading volume, which completely changed the trading game forever. The advancement of algorithms began to make it much more difficult for level 2 traders like myself to profit consistently. Algorithms are constantly adding and pulling orders from the book, decreasing the transparency and ultimately the overall effectiveness of a level 2. I reached a point in my career where I had to develop new strategies as solely relying on a level 2 had become very difficult. From 2009 to 2011, I was trading an algorithm that arbitraged an opportunity that existed at some of the retail Forex brokers that were popping up everywhere online at the time. The algorithm required very little of my time. I spent most of my spare time focused on developing new strategies. Having experienced the increase in algorithmic trading firsthand and how it had changed the game, I wanted my strategies primarily to focus on executed orders. I became obsessed with studying volume and testing different indicators. After thousands of hours of trading and screen time, I developed new strategies, largely through the use of footprint charts, which mimicked what the level 2 used to provide me: the ability to see and feel the pulse of the market. Footprint charts brought market supply and demand back to life for me. For the past decade, footprint charts, more specifically a certain style that we'll talk about shortly, have remained the number one edge I use in my trading. You can use footprint charts to trade any market, including stocks, futures, forex, crypto, you name it. They're great for day trading, swing trading, and even long-term investing. There are three primary styles of footprint charts we're going to cover, including the bid-ask footprint, the delta footprint, and finally the volume footprint. We'll start with the bid-ask footprint, which is a traditional footprint you're probably the most familiar with or have at least seen. We can use the bid-ask footprint to spot market imbalances as well as unfinished auctions, which we will cover shortly. First, we need to cover a few basics so I can show you how to read the bid-ask footprint. The price of any security depends on whether you wish to buy or sell. When you want to buy a security, the price you will pay is the asking price. It's the price the counterparty is willing to sell at. If you wish to sell a security, the price you will receive is the bid price. It's the price the counterparty is willing to buy at. In this example, if you were looking to buy an E-mini S&P 500 contract, you would pay the asking price of $30.1050. If you were looking to sell an E-mini S&P 500 contract, the price you would receive is the bid price of $30.1025. I want to cover some important terminology quick, as you will often hear me say it in my videos. The act of buying with a market order is known as taking the offer, or sometimes I will say lifting the ask. The act of selling with a market order is known as hitting the bid. So in this example, if you bought the ask price, you would say, I took the offer at $30.1050. If you sold at the bid price, you would say, I hit the bid at $30.1025. Next, let's take a look at a trading dome, which stands for depth of market. The dome shows all of the resting limit orders in the market, also known as the advertised prices. In this example, the current market is 30.1075 by 30.11. Sellers are prepared to offer 380 contracts for sale at 30.11, the ask price, and buyers are prepared to purchase 1,150 contracts at 30.1075, the bid price. Finally, let's break down the different components of a bid-ask candle and then get into some strategies. The volume highlighted in green is the amount of volume that traded as a result of market orders hitting the bid at the corresponding price. The volume highlighted in red is the amount of volume that traded as a result of market orders taking the offer at the corresponding price. Considering a price quote is made up of a bid and an ask price, you have to look at the figures diagonally. For example, when price was at 28.74 by 28.7425, 113 contracts traded on the bid at 28.74, and 173 contracts traded on the offer at 28.74.25. We can use these values to find imbalances in the market. In fact, most charting software on the market today that have footprints will automatically do it for you. On this bid-ask chart, you'll notice some of the volumes are highlighted in green or red. The ones highlighted in green are buy imbalances because they occurred on the offer and were over 300% higher than the corresponding bid. The ones highlighted in red are sell imbalances because they occurred on the bid and were over 300% higher than the corresponding offer. 300% is a setting that I personally use for my buy and sell imbalances. Most footprint charting packages will allow you to specify what you want to use for an imbalance. Let's take a closer look at the candle that formed at noon. You'll notice a buy imbalance highlighted in green of 885. A total of 885 contracts traded on the offer versus 281 contracts that traded on the bid. 885 divided by 281 equals 3.1, which is an imbalance of over 300%, so the offer is highlighted in green. We can use large imbalances and stacked imbalances to find high probability support and resistance levels where price could reverse. Stacked imbalances are simply multiple imbalances spread across a few price increments in a tight range, as you see here. Large buy imbalances will tend to act as support if price retraces back to test the level, and large sell imbalances will act as resistance. Here's an example of using a buy imbalance to find a support level for an entry. Price breaks out to the upside, establishing a new trend. We would have used the stacked buy imbalances to look for a long entry as price retraced, found support, and began to rally again. Here we have an example of some stacked sell imbalances. Notice how price retraced back to these levels and once again was rejected and continues a downward trend. We can also use the bid-ask footprint to find finished and unfinished auctions in the market. Up auctions, bullish moves, end at a price level above which no active buyers are willing to buy. The price has become too unattractive to the buyers. This is notated on a bid-ask chart by a 0 on the bid at the high. Price couldn't go a tick higher because there was no passive buyers looking to buy. This would be considered a finished auction. Down auctions, bearish moves, end at a price level below which no active sellers are willing to sell. This is notated on a bid-ask chart by a 0 on the offer at lows as seen here. Price couldn't go a tick lower because there were no passive sellers looking to sell. Once again, we have another finished auction. Unfinished auctions are represented by volume trading on the bid as well as the offer at a session high or low. They provide logical areas we can expect prices to visit again in order to complete the market's auction process. Now, I wouldn't begin fading a move simply because you see an unfinished auction. Where you will find value in unfinished auctions is by using them to determine a take profit. Let's look at an example. Let's assume you had a trigger that got you into a long position somewhere down near this double bottom. You could use the unfinished auction that you see here as your take profit. The next style footprint chart is the Delta footprint. Delta is an extremely powerful tool for day traders and an important indicator I use in my scalping strategy that I've traded for the past 10 years. Volume delta is the difference between buying and selling pressure. It's calculated by taking the difference of the volume that traded at the offer price and the volume that traded at the bid price. Therefore, volume delta equals offer volume minus bid volume. If delta is greater than 0, buyers are the aggressor, as more contracts traded on the offer than the corresponding bid. If delta is less than 0, the sellers are the aggressor, as more contracts traded on the bid than the corresponding offer. The bid-ask candle here on the left is the exact same candle as the delta candle on the right. 26 trades took place on the bid at the lowest price point on the bid-ask footprint and 0 on the offer. Remember, delta equals offer volume less bid volume. Therefore, 0 minus 26 equals a delta value of negative 26 as seen on the delta candle here. Let's do the calculation for the price level second from the bottom. 341 trades took place on the offer and 481 trades took place on the bid. 341 less 481 equals a delta rating of negative 140, which can be seen here. Delta and price will typically move in the same direction, which makes sense, right? If buyers are aggressively buying, taking the offer, then price should go up, and if sellers are aggressively hitting the bid, prices should go down. So what's occurring in this example where there's a divergence between price and delta? In this example, price is in a downtrend and begins to retrace and test a prior swing high. Notice how we have positive delta and a large print signifying an influx of buy market orders, but price actually closes lower. When we have a divergence like this, Sellers are aggressively selling on the offer with limit orders, enough so that it's holding off the influx of buy market orders, a sign of a potential reversal, which is exactly what occurs. Here's another example of divergence. We have a large negative delta print at lows, but price closes higher. What's occurring is buyers are stepping on the bid with limited orders faster than sellers are hitting the bid with market orders, and once again, the trend resumes. The final footprint style we're going to take a look at is the volume footprint, sometimes called a volume imprint or just simply a volume profile. Volume always has a story to tell. In fact, I believe it's the most important story the market is trying to tell you. If you're interested in trading order flow, I would begin by learning how to use volume profiles. I use volume profiles to build context around my trades. You can think of context as a CEO of your trading business. It looks out above the trees and says, we're going that way. When using a volume profile, there's four critical pieces of information to observe. First, we have high volume nodes, which are areas of high volume relative to surrounding nodes. Next, we have low volume nodes, which as the name implies are areas of low volume relative to surrounding nodes. Third, we have the point of control, which is simply the price level where the highest level of volume traded for the user-defined interval. And finally, we have distribution, which is the current price's location relative to a high volume node. High volume nodes act like gravity. They tend to attract price and try to hold it there. Conversely, low volume nodes are areas with very little gravity. The market often rips right through these levels, not staying for long because of the low liquidity. Let's take a look at some examples of how you can use these components in your trading. Prior points of control and high volume nodes will act as support or resistance when price is retracing back into them. You can look to play reversals at high volume nodes in the direction of a trend, as seen in this example here. HVNs are also great to use in your trade management. When long, you can trail your stops below HVNs as the position moves in your favor, or if you're short, you would simply trail your stops above HVNs until you're taken out. This has been a very basic overview of how you can use footprint charts to improve your trading. I go much more in depth in my free day trading course, link in the description. It's time for you to get your hands dirty by trying out footprint charts for yourself. Here are some software recommendations I suggest you check out. The three big names in the industry are MotiveWave, CR Chart, and Quantower. I've personally used MotiveWave for the past couple of years. It's what you've seen in this video. It's a great platform and I highly recommend it. Next, we have Sierra Chart, which is an extremely lightweight and robust platform. Their graphical user interface is getting a little dated, but again, it's still a great platform. I used Sierra for almost a decade, and still to this day, I highly recommend it to my students. I made the switch personally to MotiveWave simply due to the fact that I wanted something that could run on Mac OS. If you want to run Sierra on your Mac, you would need to install Boot Camp or Parallels. Finally, we have Quantower, which is fairly new order flow software, but gaining some steam really fast. I have demoed the product and liked what I saw, so I definitely would check them out as well. I did an in-depth review of all of these platforms in another video, link in the description as well. They all have demos, so I would spend some time checking them all out. If you have any questions regarding footprints or want to mention a piece of software that you've tried, make sure to leave a comment. More importantly, if you like this video, help me out and give it a thumbs up and subscribe to the channel. In doing so, I promise to continue to produce videos that I'm confident will help you on your journey to becoming a successful day trader. I'll see you in the next video. Take care.